One of the most successful investors in history, Warren Buffett has amassed a net worth of more than $11.8 billion at this point in his career. His approach to investing, which is predicated on the principles of discipline, value, and patience, has resulted in returns that have routinely surpassed those of the market for many years. Regular investors, the rest of us, don't have the money to invest the way Buffett does, but we may follow one of his constant recommendations. Low-cost index funds are the wisest investment most people can make. What's up, everyone? Capital Finance here. In this video, we will talk about how to invest and get rich through index fund investment. So, stick to the end of this video to find out. In a letter to shareholders that he sent in 2016, Warren Buffett stated that when trillions of money are handled by Wall Streeters collecting huge fees, it will frequently be the managers who earn outsized profits rather than the customers. Low-cost index funds are the way to go for investors of all sizes, huge investors and little ones. But first, what are index funds? An index fund is a type of investment vehicle that replicates the performance of a market index, which is generally composed of equities or bonds. Index funds often make investments in all of the components included in the index they follow. These funds also typically have fund managers whose responsibility is to ensure that the index fund achieves the same level of success as the index. Aside from the S&P 500, there are indexes for almost any market or investment strategy that you can think of. You can purchase index funds through your brokerage account or directly through an index fund provider, such as BlackRock or Vanguard. Both of these options are available for almost everyone. When you purchase an index fund, you invest in a simple and inexpensive vehicle that provides access to a diverse portfolio of assets. Some index funds offer investors exposure to hundreds of assets inside a single fund, which, thanks to the fund's vast diversification, can help investors reduce their total risk. You can also build a portfolio that corresponds to the asset allocation you want to achieve by making investments in several index funds that track various indexes. You may, for instance, invest 60% of your money in stock index funds and 40% in bond index funds. What benefits can you get as an investor from index funds? Index funds offer several advantages, the most notable one being that they have generated higher total returns than other forms of funds. Because they are passively managed, one of the primary reasons for this is that, on average, their management costs are far cheaper than those of other funds. The index fund's portfolio simply replicates that of the index that is designated to track, instead of having a manager who engages in active trading and a research team that analyzes stocks and makes recommendations. Index funds are mutual funds that retain investments until the underlying index changes, which does not happen frequently. As a result, index funds have lower transaction fees than other mutual funds. These reduced expenditures can significantly impact your results, particularly throughout a more extended period. Now, there are 3 steps to investing in an index fund. Number 1. Choose your desired index. Index funds allow investors to monitor a wide variety of indices, which number in the hundreds. The S&P 500 index is the most widely followed index since it tracks the performance of 500 of the most important firms listed on the stock market in the United States. The S&P 500, the S&P Small Cap 600, the MSCI Emerging Markets Index, and the Bloomberg Barclays Global Aggregate Bond Index are among the most prominent indexes. In addition to these more general indexes, there are also sector indexes that are specific to certain industries, country indexes that focus on the stock markets of individual countries, style indexes that place emphasis on rapidly expanding companies or low-priced stocks, and other indexes that restrict their investments based on their own internal filtering systems. Number 2. Pick the right fund for your index. When you have settled on an index, you should have no trouble locating at least one index fund that replicates it. You could have a dozen or more options that all follow the same index for significant indexes like the S&P 500. If there is more than one index fund that tracks your preferred index, you will want to ask yourself the following fundamental questions. To begin, which index fund comes to the closest to exactly replicating the index performance? The second question is, which index fund has the lowest fees overall? The third question you should ask is whether or not an index fund has any constraints or limitations that prevent you from investing in it. And last but not the least, does the fund supplier provide any further index funds that you would be interested in using? Selecting the best index fund for your needs should become much simpler if you find the answers to those questions. Number 3. Purchase index fund shares. You have the option of opening a brokerage account, which will provide you the ability to purchase and sell shares of the index fund that interests you. You also can open an account directly with the mutual fund firm that manages the fund, which is the most common practice. You need to consider the fees and benefits associated with each method of purchasing shares of your index fund before making a final decision. Creating a fund account directly via the index fund firm is more cost-effective than going through a broker because some brokers assess additional fees to their clients when they purchase index fund shares. Despite this, most investors choose to consolidate all of their holdings into a single brokerage account. Suppose you want to invest in a variety of index funds that are managed by a variety of different fund managers. In that case, selecting the brokerage option may provide you with the most advantageous means of consolidating all of your investments into a single account. What are the negative aspects of investing in index funds? There is no such thing as the perfect investment, including index funds. One problem is inherent in their very nature. A portfolio that grows and falls with index has the same drawbacks. For instance, if you have a fund that tracks the S&P 500, you will have great success while the market is performing well. But you will be in a precarious financial position once the market experiences a decline. In contrast, if the fund is actively managed, the fund manager may anticipate an impending market downturn and either make adjustments to the portfolio's holdings or sell some of them to prepare for it. Before you invest, you shouldn't put money into any fund unless you've given the available facts about that being significant fund consideration. This comprises the most current shareholder report and the fund's prospectus. In addition, funds are required to publish quarterly shareholder reports. You may often obtain this information by visiting the fund's website or speaking with a financial advisor. So, now that you've learned all these things, here are 4 indexes you can invest in to get started on your index fund investment. 1. The Vanguard 500 Index, which tracks the S&P 500. It only has a $4 annual cost for a $10,000 investment. 2. The Vanguard Total Stock Market Index, which tracks index of U.S. stocks. It also has an annual investment cost of $4 for a $10,000 investment. 3. The Vanguard Total International Stock Market, which tracks index of global stocks. It only has an annual cost of $4 for a $10,000 investment. In conclusion, index funds provide investors of all experience levels with a straightforward and fruitful option to invest their money. Index funds are an excellent option to consider if you want your money to grow but don't want to spend a lot of time researching the best ways to increase your money. This can help you reach your financial objectives. So, I am a huge fan of index funds, particularly for beginner investors or individuals who would like not to have to actively manage their investments. You should be sure you understand what an index fund is, how it typically performs, what it follows, and the benefits and drawbacks of investing in index funds. After that, you need to make sure that the funds you're buying align with your financial goals and objectives. You shouldn't just choose funds at random because someone advised you to. Investing in an index fund may be a fantastic approach since it is very hands-off while producing high returns over the long term. And that's it for this video, guys. I hope you learned a lot about index funds. Don't forget to do more research about it before making your first investment. As always, thanks for watching. And don't forget to smash the like and subscribe buttons for more videos like this. Have a good one!